If you've spent decades building your savings, the last thing you want is a federal investigation over a perfectly legal deposit. Yet every year, thousands of Americans, many of them retirees, face exactly that situation. Not because they did anything criminal, but because nobody explained the rules clearly. Today, I'm going to change that. Under the Bank Secrecy Act of 1970, every financial institution in the United States, every bank, every credit union, every savings and loan is legally required to file a currency transaction report, known as a CTR, whenever a customer conducts a cash transaction exceeding $10,000. This report is filed on FinCEN Form 104 and submitted directly to the Financial Crimes Enforcement Network, FinCEN, a bureau of the U.S. Treasury Department. The bank files it. You don't sign anything. You may not even be informed it happened. Here is what's critical to understand. A CTR is not an accusation, and it is not an audit. It is routine compliance reporting. The vast majority of CTRs result in zero follow-up. Your account remains untouched. Your life continues normally. The danger is not the report. The danger is what people do when they find out about it. When retirees learn about the $10,000 threshold, a common reaction is to break deposits into smaller amounts, $7,000 one day, $6,000 the next, believing this protects them from scrutiny. It does the opposite. This practice is called structuring, and it is a federal offense under 31 U.S. Code, Section 5324, regardless of whether the money itself is legal. Penalties include up to 5 years in federal prison and fines up to $250,000. For amounts over $100,000, those penalties double. In all cases, the government may seize the funds through civil forfeiture. A study by the IRS found that 91% of structuring forfeitures involve legally sourced funds. 9 out of 10 people who lost their money to this law were not criminals. They were law-abiding citizens who made an uninformed decision. Beyond the CTR, banks also file suspicious activity reports (SARs) when transaction patterns appear unusual. There is no minimum dollar threshold for a SAR. A bank can flag a $300 transaction if the behavior looks like an attempt to avoid detection. Federal law prohibits the bank from notifying you that a SAR has been filed. This is precisely why breaking deposits into smaller amounts is so dangerous. The software banks use is specifically designed to identify that exact pattern. The correct approach is straightforward. Deposit the full amount in a single transaction. Maintain clear documentation of the source, a bill of sale, a gift letter, and a state settlement document. Answer the teller's questions briefly and honestly. Do not volunteer additional information and never express concern about triggering a report. Create a dedicated folder for transaction records. For every significant deposit, note the source, the date, and the amount. Supporting documents go in the same place. This takes minutes to maintain and serves as your complete defense if questions ever arise. A proposal currently before Congress, the Streamline Act of 2025, would raise the CTR threshold from $10,000 to $30,000 and index it to inflation. It has not passed. Until it does, the threshold remains where it has stood since 1970. Know the rule, follow it correctly, your financial security depends on it. If you found this video helpful, subscribe for more retirement, banking, and personal finance insights that can help you protect your savings and avoid costly mistakes. And if you know someone who is retired or approaching retirement, share this video with them. Understanding a simple banking rule today could prevent a major headache tomorrow. Thanks for watching, and I'll see you in the next video.